Subscribe to our YouTube channel and press the bell icon to get the latest updates.
Hello everyone, Rahul Shah here, trying to make investing accessible and profitable for the average investor. It goes without saying that stock market losses hurt. Losses don't go down well with our brains. There are proven psychological studies around this. It is believed that we individuals feel the pain of loss twice as intensively than the equivalent pressure of gain. And this pain of fear is not without reason. For example, if you lose 50% in a stock, you need to invest in a two-bagger just to break even on that sum of money. If you lose 80% in a stock, you need a five-bagger to break even on that sum of money. And God help you if you lose 90% in some stock. You will need a huge 10-bagger just to get back your original investment. Is it any wonder that people are so loss averse when it comes to investing? So how do you minimize losses in investing? I'll be honest with you. It is impossible to have a totally loss-free portfolio. Losses are part and parcel of investing, especially if you've been investing for long. Therefore, to completely eliminate losses is like living in a fool's paradise. But there's something else you can do. You can try to minimize your losses. You can try to keep your losses to a bare minimum so that they don't cause a big dent to your long-term portfolio. One of the best ways to do this, in my view, is to avoid toxic stocks. Yes, you heard that right. If you want to prevent large-scale wealth destruction, then stay away from toxic stocks as far as possible. Now the question is, what exactly are toxic stocks and how do you identify them? Well, there is no universal definition of a toxic stock. Each investor can define it the way he wants. However, as far as my definition is concerned, toxic stocks are stocks that are expensively valued and have weak balance sheets and are also frequently loss-making. Let me repeat that. Toxic stocks are stocks that are expensively valued, have weak balance sheets, and are frequently loss-making. In fact, this is not the first time I'm making a video on toxic stocks. My first video on toxic stocks went live on 6th of January this year. In it, I had labeled the following stocks as toxic and had asked investors to stay away from them. Here's the full list for you. There are 22 names in it, starting right from Adani Green Energy to Wokhar Limited. These stocks were shortlisted based on the three rules that I just highlighted. That is expensive valuations, weak balance sheets, and loss-making operations. I would recommend that you watch the 6th Jan video if you want to get into the full details of how I managed to shortlist these stocks. However, in today's video, let's discuss the performance of these stocks. You see, the year 2022 is coming to a close. Therefore, it will be interesting to see how my list of toxic stocks has performed in the current calendar year. Did they really prove to be toxic as the name suggests, or were they not toxic at all and instead ended up giving good returns? Well, let's find out. As you can see, out of 22 stocks, 12 stocks have destroyed investor wealth in 2022 so far, while the remaining 10 have given positive returns. The biggest loser, Tata Teleservices Limited, is right at the top. The stock is down almost 60% in 2022 so far, followed by Vodafone Idea, SpiceJet, Wokhar, and others. In terms of gainers, Adani Power, which we labeled as one of the 22 toxic stocks, has done a complete U-turn. Instead of collapsing, the stock price has skyrocketed and has earned almost 230% returns for investors in 2022. So what do we make of these numbers? Was it correct to label these stocks as toxic stocks, or have I misguided investors and made them miss strong performers like Adani Power, Lemon Tree Hotels, and Swan Energy? Well, if you had invested ₹100 in each of these stocks right after I published the list, you would have earned a positive return of almost 11% so far in 2022. This is much better than the 2% returns earned by the Sensex during the same period. Therefore, it will be safe to say that a portfolio consisting entirely of my 22 toxic stocks would have ended up outperforming the benchmark index. Well, toxic stocks was meant to destroy investor wealth and not build it. However, this toxic stock portfolio has increased investor wealth by 11% and has even outperformed the index. Therefore, you can say that collectively these stocks have not proved to be toxic at all. In fact, they have proved to be market beaters. So, has my list of toxic stocks failed? Should I discard it and come up with better rules for shortlisting these stocks? Well, not so fast. We compared the performance of the toxic stock portfolio with the Sensex and realized that my toxic stock portfolio earned 11% returns versus 2% by the Sensex. But what if we remove the outlier, that is Adani Power? As you saw, Adani Power was the best performing toxic stock in 2022. It was up more than 3x. However, if you remove Adani Power from the list, then the returns of the portfolio fall to just 0.6% from 11%. In other words, the toxic stock portfolio has given almost flat returns in 2022 and has now underperformed the Sensex. Without Adani Power, the portfolio has indeed turned out to be somewhat toxic. Now, another way of evaluating the performance of the toxic stock portfolio is to compare its returns with a non-toxic portfolio. Yes, you heard that right. The real test of a toxic portfolio is when you compare it with a non-toxic portfolio and then measure the difference between the two portfolios. If a non-toxic portfolio has destroyed less wealth in a bear market or has given significantly better returns in a bull market, then I think it makes sense to stay away from toxic stocks. So let's compare the performance of my toxic portfolio with a non-toxic portfolio. Here's the returns comparison of the two portfolios during the same period. As you can see, the non-toxic portfolio has done really well, earning close to 21% during the year versus flat returns given by the toxic portfolio. Therefore, if you go by this table, it really pays to avoid the toxic portfolio and create a portfolio similarly to the non-toxic portfolio. I'm sure you're wondering how exactly I put together a non-toxic portfolio and what are the kind of stocks I have in them. Well, the non-toxic portfolio is the exact opposite of the toxic portfolio. The rules are mirror image of each other. Here's what I mean. The first rule of the toxic portfolio was to avoid expensive stocks, that is to keep away from stocks that are trading well above their intrinsic value. I'm of the view that you should not pay more than 25 times to 30 times for even the best quality stocks. For the purpose of creating the toxic portfolio, I have been a little lenient and have considered a PE ratio of more than 40x. Therefore, if the stock is trading at a PE of more than 40x or has a negative PE ratio, which means that the company is loss-making, it satisfies the first rule of being toxic. Hence, for the non-toxic portfolio, I have considered the same universe of BSE 500 stocks. However, I have considered only those stocks that were trading at a PE of less than 13 times to 14 times. I have mentioned in quite a few of my previous videos that I don't like paying a lot of premium even for the best quality stocks. If it is an average company, the maximum PE that I would give to a stock is not more than 13x to 14x, which is roughly equivalent to the AAA corporate bond yield. In fact, if it's a small cap or a micro cap, then my ideal PE multiple is even lower at single digit perhaps. But since these stocks are from the BSE 500 universe, I am willing to pay a small premium but not go beyond 13 times to 14 times. So the PE limit for my non-toxic portfolio is 5x to 13x. I think stock below 5x, especially in the BSE 500 universe, are mostly value traps and therefore I prefer a PE of more than 5x. Now coming to the second rule of the toxic portfolio, that is a weak balance sheet. For the non-toxic portfolio, I consider a DE ratio or a debt to equity ratio between 0 and 1. If the debt to equity ratio on the balance sheet is less than 1, then the company is on a strong financial footing in my view, and therefore that's the second rule for my non-toxic portfolio. The stock should not be leveraged and the debt to equity ratio should be less than 1. The third rule for the non-toxic portfolio is that it should be profitable in at least 4 of the last 5 years. This is again opposite of the toxic portfolio where the rule was that if the stock is loss making for 2 or more years in the last 5 years, then it satisfied the third rule of being toxic. So this is a brief explanation of the 3 rules of the non-toxic portfolio: P/E ratio between 5x and 13x, debt to equity ratio between 0 and 1, and profit making for at least 4 of the last 5 years. As I mentioned earlier, a portfolio of stocks that passed all the 3 conditions was deemed the non-toxic portfolio, and it earned a handsome return of 21% in 2022 so far. While 33 stocks passed all the 3 rules of the non-toxic portfolio, and here are the names in the descending order of returns. Mazgaon Shipbuilders was the top performer in the non-toxic portfolio. It has multiplied almost 3 times in 2022 so far. Hindustan Aeronautics is second, up more than 2x, followed by Cochin Shipyard and going all the way to Vardhaman Textiles, which is down almost 34%. So here's my takeaway. Staying away from toxic stocks and investing the same money into a non-toxic portfolio can prove to be a good decision in the long term. It could fulfill its goal, which is to avoid big wealth destruction in the portfolio. Of course, I am drawing this conclusion based on just 1 year study. However, the odds are stacked heavily against the toxic stocks. There is very little chance that they can outperform the non-toxic portfolio over a reasonably large period of time. Over the long term, fundamentals always win in my view. There is indeed a strong case to avoid toxic stocks in your portfolio. Now it is time to take a look at the list of toxic stocks that you can do well to avoid in 2023. I have used the same rules that I used for 2022. These are valuations, balance sheet strength, and whether operations are profit making. These are the stocks that could not clear all the 3 rules. They failed on each of these parameters and are therefore toxic in my view. Well, the list has almost the same companies as the list for 2022, except that there are fewer stocks. Last time we had 22 stocks, and this time we have 17 stocks that failed on all the 3 filters or passed all the filters of being a toxic stock. There are only 2 new additions this time: Ashok Leyland and PVR Limited. Please note that this list is entirely based on objective parameters and there is no subjectivity involved. It is all rules based. This means that stocks that satisfy all the conditions of being toxic are included, and stocks that don't satisfy even one condition are excluded. There is no personal bias or personal agenda here. So this is the list of toxic stocks for 2023, stocks that can end up harming your portfolio if there is a big crash in the market. Let me know what you think of these names. This brings me to the end of this session. I hope you liked it. Please do not forget to leave your feedback in the form of likes or comments. I'll see you again next time. Goodbye and happy investing.